What's going on, guys, and welcome back to another video. So far this year it's been a relatively bumpy ride in the stock market. We've had quite a lot of volatility. We can see here that the Nasdaq 100 is down 3.5%, and actually it was down as much as 5.5%, and that is just year to date, and we're not even 2 weeks into the year, right? And now 3.5% or even 5.5% doesn't sound all that much for an index to be down, but when an index is down by 3.5 or 5.5%, you can be pretty certain that there are going to be a bunch of stocks within that index that are actually down far more than that. So maybe 25 or even 30%. So there is a lot of volatility, and I don't need to keep banging the drum about that. You guys all know, you'll see it in your portfolios. And for what it's worth, I think that this volatility is actually going to continue for much of the first half of 2022. So that's my prediction for this year. There's a bunch of reasons as to why I'm expecting volatility, the macroeconomic environment being the main culprit, if you like. But anyway, that's a prediction, and nobody really knows, right? I mean, if I did know, then I'd be a very rich man. Unfortunately, that's not the case. Anyway, today's video is actually going to be 5 stocks that I think are all going to perform very well in 2022. And I'll give my reasons for those. Now, all of these 5 stocks I have covered in previous videos before, and therefore I'm not going to go into too much depth in them. I will link the videos relevant to each of the stocks within the description if you want to go and have a deeper look at those. Anyway, without further ado, let's just dive right in. So coming as a surprise to absolutely nobody that's watched my previous videos, the first stock on the list is Discovery. Now, Discovery has had a solid year so far. We're 2 weeks in, and the stock's already up 14%, which is pretty good. I actually think, right, that we're going to continue to see this rise in share price as we come closer to the merger with Warner Media. Now, in terms of what has effectively triggered that huge jump there, I think that was a 17% jump in one day, which for a stock like Discovery is pretty much unheard of. I actually read something that said that was its largest gain since 2008, right? So 13 years later, that's all 14 years later even now, that is the largest gain that it's had. So we don't see those kind of swings in one day with a stock like Discovery. In terms of why we saw that gain, well, a Bank of America analyst said that effectively they've increased their price target from $34 to $45, and they are very bullish on the merger. And I have to agree with them. I'm also very bullish on the merger with Warner Media, because I think that this is going to create, and I seriously believe this, it's going to create a streaming giant that is going to compete with the likes of Netflix and with the likes of Disney Plus, except it doesn't come at the moment with the valuation which would suggest that. So I personally hold the view that there is an asymmetric risk to reward ratio, and the Bank of America analyst agrees. And we can see here that she classified the stock's risk to reward ratio as highly favorable. So this is my high-level valuation of the new company that's going to be formed, and I ran through this on my previous video, which I will link in the description, and I may also put a caption there if I remember right. However, we can see that we're ending the year at around 83 million subscribers. We're expecting that to grow to 100 million subscribers by the end of this year, and that's a 20% gain. So management have told us to expect the merger to go through at some point in the first half of 2022. My personal expectation is that it will probably go through between April and May, somewhere around that time. Either way, I'm very confident that the merger will go through. And the thing that I love about this business, and actually before I get onto that, right, if the merger does go through, we see a 20%, potentially, according to my valuation model, compounded annual growth rate on this business through to 2027. And I think that when the markets realise the potential for the business in terms of both the number of subscribers that they've got, the content library that they've got, and how they will be competing with those streaming giants that are out already, when you compare the valuations between the two, it really doesn't make sense at this point, in my opinion. With that being said, even if the merger doesn't go through, and this is what I was getting at as to that sort of asymmetric risk to reward ratio, even if the merger doesn't go through, I think that the underlying fundamentals of Discovery itself are also very strong. And I think that the Discovery business as a standalone business is also undervalued. So in my opinion, it's a win-win really. And that is the asymmetric risk to reward ratio that I'm talking about. I'm expecting a good 2022 for Discovery. We've started well, let's hope that continues. Probably spoke about Discovery for slightly longer than what I wanted to, so let's move swiftly on to stock number 2, which is another stock that's been performing very well so far this year, and that is Alibaba. Once again, it probably won't come as a surprise that this is number 2 on the list. So Alibaba has been performing very well so far this year, and it's up 14% year to date. Now that contrasts starkly with the kind of performance that we're used to seeing, especially over the last 6 months or even over the last year, where we're down 42%, right? So clearly year to date, they're performing very well. We'll see how that continues. In terms of why we're performing well so far this year, well, there's a couple of reasons. I think that people are starting to realize that the geopolitical risks that were exaggerated in the market or in the media really were overblown. So that's number one. And that is sort of explained through this article here. So once again, I'm not going to go through the details of the variable interest entity structure and why that could pose a risk to any shareholders. But what I will say is this, and the reason for that is because I've got it in previous videos. Once again, I'll link it somewhere in the description. However, right, we can see here that the China Securities Regulatory Commission said last Friday that companies operating with a so-called variable interest entity structure seeking to list abroad will need approval from the watchdog before the deal goes ahead. So what does that mean? Well, in the media, right, we've been told constantly, over and over again, that the Chinese government are not happy with the variable interest entity structures, and the reason for that is because it circumvents effectively a policy that was put in place at some point. And that policy was that they didn't want foreign investors investing in some of China's best companies, particularly technology companies. And that is a real law that they have in place. But the variable interest entity structure has existed for a number of years and then has never been an issue. With all of that being said, right, the fact that the Chinese regulatory body wants to make sure that companies are seeking appropriate approval before going through this VIE structure implicitly effectively tells us that they are comfortable with the VIE structure, right? If they weren't comfortable with the structure, they wouldn't even say people should need to be seeking, approval before going via this route. They would just say, don't go via that route, right? So the fact that, the whole VIE structure and that the shares are going to be delisted and all of these other issues that have been apparently existing for Alibaba and other Chinese tech companies, I think is well overblown. And I think that as time goes on, people will realize that actually nothing is happening, right? Of course, you still need to be aware that by owning the Alibaba shares, you actually don't own the holding company itself. You hold shares in another company, which gives you the rights to the profits and not the assets of the company. But that's something that anybody that's invested in the business, anybody that's done their due diligence should be aware of. And all of that shouldn't really be an issue if you're comfortable that actually the fundamentals of the business suggest that despite all of that, it's still undervalued. But I'm not the only person that believes that, right? So we can see here that we've got Charlie Munger, who is the owner of the Daily Journal Corporation, and this is his personal portfolio. He only holds 5 stocks, one of those which is Alibaba, with a total percentage of his portfolio of 28%. So he first started buying this stock back in Q1 of 2021. He then doubled his position or almost doubled his position. He had 83% in Q3 2021. He then did double his position in Q4 2021, and this is at the height of all of the scaremongering, if you like, that was going on in the media. So clearly Charlie Munger isn't concerned, and the reason for that is because he doesn't pay attention to the noise in the media. He pays attention to the fundamentals of a business. And Charlie Munger isn't the only person that isn't concerned with the noise in the media. And we can see here that actually there have been a bunch of senators and congresspeople that have been purchasing stocks in Alibaba. And if you think about it, right, you'd expect these people to have the greatest amount of awareness of any tensions between, for example, China and the US and what that could mean for stocks of Chinese stocks, I suppose. But that hasn't stopped a bunch of people buying stocks. So we can see here that Tommy Tuberville once again bought Alibaba stock and options. And it's not just him, there are a bunch of other people as well. And as a result of that, it sort of makes me think that maybe, just maybe, right, which is something that I've been saying all along, all of these fears have been overblown. And the reason why I think that Alibaba will do well in 2022 is because people are going to realize that, there's only so much, or there's only so long in terms of a length of time at which people can continue to sort of say that something is going to happen, for example, the delisting of the shares, and that thing not happen, and people continue to believe it. And I think that we're going to see that with Alibaba. So stock number 3. So we've had 2 stocks that have performed fairly well over 2022 so far, and now we're on to a stock that actually hasn't performed well in 2022 and also had an absolutely horrific 2021, down 53% over the last year. So what is the cause of Pinterest having an absolutely horrific 2021? It all comes down to the monthly active users and the fact that monthly active users have actually been declining, especially their US users. And so the sort of theory goes that because people were in lockdown, people were stuck at home, more people were spending more time on their phones. And that is true, and we know that as fact. And as a result of that, Pinterest saw an increase in their monthly active users. And now, effectively, because restrictions have been lifted and so on, those monthly active users are going to decline, and they are going to continue to decline. In my opinion, that, you know, there's an element of truth there. I actually think that these numbers are going to probably stabilize for a while. I think that we've probably hit saturation in the US numbers. I think we'll start to slowly see uptick in the international users over time. But again, yeah, that might take a little while. The reason why that doesn't bother me is because actually the money to be made is to do with increasing their average revenue per user. And as a result, even if we see a small decline in their actual user base, if they can continue to monetize their existing users, that will more than offset that. So Pinterest have been able to grow their average revenue per user at a solid rate. And we can see that on the US side, they're achieving average revenue per user of $5.55. And that's a strong growth year over year of 44%. So that's clearly very strong, but I think that there's a lot of room to grow there. We look at a company like Facebook, and their average revenue per user is around $55. I think that the long-term goal for Pinterest for their US user base can be as high as $20. And I'm referring to sort of 10 years into the future from now. So that's the first thing. The second point is that I don't think that many people are appreciating that as they start to ramp up their international average revenue per user, which is only sitting at 38 cents at the moment. And the reason it's so low is because they've literally only just started to monetize that user base, and they're still learning what the best way of monetization would be for those particular users. With that being said, it was still 81% growth. And I think that as they continue to grow out this international average revenue per user at a greater rate, we'll start to see the significant uptick in their revenues. And the reason for that is because their international user base actually makes up around 75% of their total users. So as they continue to grow this user base, and clearly, right, at 38 cents per user, there is a lot of scope for growth. But it's not just that, it's also the fact that Pinterest are expecting to put in significant growth in 2022. So a lot of people are paying attention to their revenues and the fact that we're expecting revenues to slow down. And we can see that here, that we're expecting revenues to increase by 26%, which is solid growth, but it's certainly not the 50% revenue growth that we're used to. But when you take it down to a profit level, we can see here earnings before interest and tax. We're actually expecting earnings before interest and tax to increase by 60%. So their earnings are growing more than twice as fast as their revenues. And so, you start to see the margin expansion come into play there. And as a result of that, I think that Pinterest are going to have a great year financially. And I also think that the stock is going to have a great year as well. So following on from Pinterest, the fourth stock on the list is Meta. And now this, some people will say, is a little bit of a strange pick for Meta to perform very strongly in 2022, because management have already come out and said that their profits are going to be impacted. And the reason for that is because they are going to be investing significantly, and I think it's $10 billion per year, into the metaverse. And as a result of that, profits are going to decline, and therefore that's going to make investors quite wary, right? Because we don't know how that is going to play out. And in effect, if it doesn't play out, then you're just wasting $10 billion of shareholder money every year, right? But there's a couple of reasons why I think that they will perform very strongly in 2022, despite that. So the first of those is the fact that this year, and in fact in Q4 of 2021, but we're going to see the results in February of 2022, will be the first time that we've ever had effectively the breakout of Facebook Reality Labs as a separate reporting segment. So effectively, we're now going to see two separate segments. The first segment is going to be the family of apps, which is what we basically know Facebook to be, being Facebook, Instagram, Messenger, and WhatsApp. And then the second segment is going to be this Facebook Reality Labs segment. which will include augmented and virtual reality related hardware, software and content. And I'm expecting this to allow management at Facebook to really paint the picture of the direction of where the business is going and the potential for Facebook Reality Labs as its separate segment. And I think that when people start to realize that there is a reason, right, why we're pumping $10 billion per year into that investment, into that segment. And that's because the new segment disclosures will provide additional information on the performance of Facebook Reality Labs and the investments we are making. So as soon as investors realize that actually that $10 billion is being allocated appropriately, and actually there's a significant amount of potential there, I think that the stock will, of course, react accordingly. And finally, the fifth stock on the list, which once again, some people might consider a little bit of a strange choice, and that is Intel. Now, I think that the reason why some people would consider this a strange choice is because management have come out and said that we are in our turnaround phase. We are going to be investing significantly into the business, and it's going to be a couple of years until we start to see the fruits of our labors. And so as a result of that, people think that this is going to be a stock that remains fairly flat over the next maybe 18 months or so before we start to see effectively the output from those investments. So we already know that revenues are going to be pretty flat for 2022. We know that free cash flow is going to be significantly reduced as a result of Intel investing something like $28 billion in capital expenditure for the year. And as a result of that, people are a little bit skeptical as to how long it's going to take before those investments actually show themselves within the financial results. And as a result of that, there are a lot of people that are saying to steer clear of Intel for the next sort of 18 months. I don't actually subscribe to that notion. Now, the vast majority of you will be aware that Intel are planning to build a number of fabs over a number of different regions in order to keep up with the demand of the growth in the semiconductor industry. And these sites, which will cost up to $200 billion over something like a 7 or 8 year period, or slightly longer than that, I believe, were meant to be unveiled by the end of 2021, but Intel delayed its decisions for unknown reasons and now plans to make the announcements in early 2022. And I think that because of that delay, there was still a little bit of negative sentiment around effectively the details of these fabs, right? So timeline and total spending, you know, the exact details of the financing and things like that, right? Which, by the way, most of it will actually just be financed through their free cash flow, because they produced, their financials are really good, that they produce solid free cash flow, that they can afford to make $20 billion worth of capital expenditures. But I think that once these details are released, investors will feel more comfortable that there aren't going to be any significant delays or any significant changes to the current plan. And the reason for why I believe that Intel is going to put in a solid performance for 2022 comes down to the fact that the shortage in semiconductor chips is not going anywhere. And we can see here that the market is projected to grow from $452 billion in 2021 to $803 billion in 2028 at a compounded annual growth rate of 8.6%. And so I think that when the market finally realizes or accepts that these shortages that we're currently experiencing aren't actually that short-term in nature, and it's not actually that easy just to ramp up production for all of the providers of semiconductor chips. As a result of that, I think that the longer-term potential for Intel will then be realized in terms of the investments that they are making today. And as a result of that, I think that 2022 potentially could be a strong year for them. So there we have 5 of my predictions for which stocks I think are going to perform well in 2022. Comment down below whether you agree or disagree with any of the stocks that I've mentioned today, and also comment down below as to what stocks you think are going to have a strong year and why. Anyway guys, I appreciate you watching the video, and until next time, thank you.